Here's a surprise. The Reserve Bank is keeping its cards close to its chest. As expected, Australia's central bank also kept the official cash rate steady for a 7th month in a row. But its statement gave few clues as to the timing of the next rate move. It signals a more cautious, patient approach, which a prominent visiting US academic suggests is prudent given the problems in Europe and the US. Here's Philip Lasker.
The mining boom may be coming, but the Reserve Bank seems slightly less convinced it's starting to carry the economy.
It's no great surprise given that run of softer data. Included in that are the fall in employment, we've seen the fall in job advertisements, and we've also seen some jitters in the global economy.
And the bank also noted investment intentions outside the resources sector beginning to weaken.
I think manufacturing's effectively in recession. If you can't grow a sector over a 12 months period, and they haven't, then I think essentially they're pretty close to recession. Wholesale's in the same area. Discretionary spend's really very tough.
So the official cash rate stays at 4.75%.
My sort of bottom line would still be that whilst they haven't gone this time, it's fairly close. And if it's not July, it's probably August. So it really depends on the data as we go forward.
Much like the Reserve Bank, we'll be watching very carefully for the data over the coming month to see whether some of those downward trends are reversed. In particular, we'll be watching the labour force data, which are out later this week, and the job advertisement numbers. And, of course, we'll be watching the world economy.
And the world economy will need watching, according to New York University's Professor of Finance, Viral Acharya. Professor Acharya worries about the lack of political consensus in the US on dealing with its debt problem, which could trigger a day of reckoning.
It's the reserve currency of the world, so as long as Europe continues to suffer, there will always be a bit of a preference to hold the US treasuries. But at some point, investors might get spooked if they don't see a reduction in the US debt happening soon. If that happens, I think you might see a trigger equilibrium that just switches everything to everyone now switching to other currencies. I don't know what's going to happen on that day.
At the same time, Europe is throwing up a different set of problems, which could have traumatic implications for Australia.
I don't see a lot of resolve on part of the European regulators to recapitalise the banking system ahead of time, rather than sort of be fighting fires once some debt restructuring has taken place. Some situation of that sort could potentially create at least a week or two of great deal of uncertainty in interbank markets. That could mean that people reliant on wholesale financing might actually get suddenly very high spreads from close to 10 basis points over risk-free rates to suddenly 100 or 150 basis points. Not because Australian banks are weak, but because those who are providing wholesale financing to them might be facing losses on their other positions somewhere else.
Disaster scenarios which don't seem so far-fetched in today's world.